Thanks so much for tuning into this very special conversation. It's an absolute delight to be talking the day post the budget, or 2 days post the budget, with Mr. Neelkanth Mishra of Axis. Neelkanth, so good having you. Thank you for taking the time out and speaking to us.
Thank you, Neeraj. Thank you, Tamanna. Thank you for having me.
Just wondering, Neelkanth, the budget should be a statement of accounts. Pre-budget, everybody is saying as long as nothing negative comes, it's great. And I don't think too many negatives came about, but for the slight pickle that people have around the quantum of capex and the growth thereof. How did you look at the budget statement and the after effects thereof, if you will?
So I have been a loud voice saying that the importance of the budget for the economy and the markets has been shrinking over the last 3 decades, and it continues to shrink. And therefore, I don't think this is very important for people to position in the markets. Even if you take the actual announcement, it was largely as expected. In fact, the fact that there would be a potentially 1 lakh crore slippage on capex, and then and a similar increase for FY26, and therefore some nominal growth in the capex by the center. The fact that the center is running out of areas to spend under the Constitution of India, it can only spend on national highways, railways, defense, telecom, major ports and airports. On many of these, there is not much of capex that you can really do. National highways, perhaps they can do a bit more, but we are reaching a level where the pace of construction is now sufficient. Railways can do a bit more, but on a base of 2.5 lakh crores, could it have gone up a lot? Maybe yes, maybe no. But beyond that, where does the government spend? Out of the 11.1 lakh crores that was budgeted in FY25, only 9 lakh crores was under his direct control. 2.1 lakh crores was stuff which was adding it over to states or giving incentives here and there. So I think the limitations on the government's fiscal path were actually becoming clear. And therefore, the only positive surprise was that perhaps the government estimated slightly more revenue than we expected. And with that 1 lakh crore of extra revenue that it saw, it handed it over to the taxpayer. So the one way to look at it is that versus FY19, FY26, the primary deficit, which is fiscal deficit minus interest cost, is now nearly back to normal. And so the COVID impact, the bump that we saw has now been very decently adjusted back. Now, when you compare FY19 to FY26, what you see is a substantial jump in the personal income tax to GDP ratio. And you also see on the expenditure side a rise in the capex to GDP ratio. That more or less is it. Now, given that you have constraints in spending on capex, because you can't spend more even if you want to, and you're still expecting more taxes to come from the personal income tax side. So you kind of circle back and give it back to the people who have been fueling this transition. I think that is all there is to it. And for those who think that this means an overall boost to consumption, guess what? The payout for this 1 lakh crores or the foregone income is also coming from the higher compliance and the higher personal income taxes. So it does boost discretionary demand in certain sectors which are greatly affected by the demand from these about 70-75 lakh people who are going to be benefiting from it. But other than that, the aggregate consumption is not getting boosted. So therefore, I think the budget was more or less as expected, with some minor tweaks as we discussed. And frankly, the trade wars and a lot of the changes happening globally are now far, far more interesting.
Yeah, and we'll come to those trade wars in a bit, but I just wanted to get a take from you on 2 points, Neelkanth. One is on the fiscal deficit glide path that the finance minister spoke about. Arguably, she has shown even a tighter position than was expected in terms of fiscal deficit, and on the nominal growth projection of 10.1%. Do you think that's conservative? Some of the commentary that we saw as we were covering the budget was that this is a government that under-promises and over-delivers. So baking in that 10.1 is a little under what was expected, but we will beat it. Just wanted to get your thoughts on these 2.
Yeah, no, that's a great question. one quibble one can have is the expectations on personal income tax growth. So the growth implied in the budget is 14%, and this is after that 1 lakh crore giveaway. And therefore, if you add that back, the underlying taxes are expected to grow at 22%. Given that percent growth this year, and while there may be some concerns on capital gains taxes, etc., the fact is STT, there's still very decent growth. So maybe they can meet that. But whatever slightly optimistic estimates there may be on that front, you're right in that 10.1% of GDP means that there is adequate buffer. So even if the economy does slow a bit or disappoint consensus expectations, at least on the headline level, the government will not be badly off. So very conservative numbers. What is much more interesting is the fiscal glide path. So the first thing is they've given now a debt to GDP anchor, which is what the FRBM review committee had suggested. I was part of an advisory council to that. It gives them a lot more flexibility. The sensitivity that they've provided at 10% nominal GDP growth over the next 5 years, 10.5% and then 11%, and the mild and moderate and the high rate of consolidation, it shows, if you do the underlying math, that the fiscal deficit going forward does not need to fall by 40, 50, 60 basis points like it was so far. Remember that in FY25, it was 80 basis points of GDP, and then this becomes 40 basis points of GDP. And then going forward, if the government's taxes are doing very well, the consolidation may be 10 basis points or 15 basis points of GDP. If the economy is slowing down and the government needs to spend more, they can do 12 plus 12 basis points or 15 basis points of GDP. So it has kept for itself some flexibility, but even through this, the debt to GDP would fall from 56% to a range of between 48 and 52%. So this is, I think, very healthy in the context of what the world is seeing. So they have, I think this is very smart budget making, and I think the fiscal glide path that they've talked about is actually should be very encouraging to the bond markets as well.
Okay, Neelkanth, the other feeling is that the ball will now squarely be in the RBI's court to do things. I mean, one independent of the budget, and like you said, a statement of accounts and non-event, but two, also because of what's happening around the world. Now, do you think that a rate cut could be firmly in place on a series of maybe a short, shallow rate cycle could be firmly in place, or is that debatable? And can the Reserve Bank do something else beyond a rate cut and some more liquidity measures? Because, well, they have done a little bit already.
Yeah, so that's now again. So take a step back. I don't think this slowdown that we have seen is a structural slowdown, meaning that there are people who believe that India's trend growth is going to be 5.5% and not 7%. I think it should be 7%. So the slowdown that has happened in our framework is a cyclical slowdown, and it has been caused by the changed rhythm or cadence of fiscal spending, and that at least is that was one part of it. Second was monetary. On the fiscal side, with December capex by the central government up 95% year on year, and even under the revised estimates, which are lower than budgeted estimates for capex, the last 3 months of the year, the government capex will be up 21% year on year. So there is quite a bit of late year tailwind to the economy coming from the change cadence of fiscal spending. On the monetary side, and therefore, but beyond that, there's not much scope. So as we just discussed, if you have promised that you will bring it below 4.5% in FY26, and you are at 4.4, then there's not much more room for you to spend to stimulate the economy. Therefore, the stimulation, a large part of the stimulation needs to come from the monetary side. Now, on monetary, we should divide that into two parts. Both are related, but not like it's not that you control one and the other automatically gets done. There is the cost of money and there is the quantity of money. The cost of money is the interest rate. There is consensus now that the RBI will be cutting rates. The MPC will be cutting rates. Frankly, if you ask me from a prescriptive angle, I don't think they should be cutting rates because it's about the stickiness of inflation, the fact that the number of items reporting above 6% inflation actually went up in December, even as the headline number came off. So inflation is starting to percolate. In fact, Ahmedabad does this business expectations, inflation expectation survey. Last month, there was a 61 basis point increase in the inflation expectation by corporate. So inflation expectations are still quite high. And if you were prescribing, you would not be prescribing a rate cut. But what has happened is that the Overton window has shifted. So the Overton window, as you know, is where consensus is. So the realm of policy making is often defined by what is acceptable to a large number of people. Now, 6 months back, the Overton window was no cuts, don't change stance, keep tight liquidity. The Overton window now is cut rates and ease liquidity. Now, I think the rate cut possibilities, we shouldn't be in a hurry, that MPC shouldn't be in a hurry. Maybe they can do it in April, they can do it in June. And if inflation does behave, maybe they can do it more. But my fear is inflation won't behave and they may not and should not be cutting rates. But they should be and can be doing a lot on the quantity side. And that's where I think the tightening has been much more meaningful. If your base money growth is below 5% in an economy growing in double digits, I think that's a huge driver of a slowdown. Credit growth falling from 17% year on year to less than 11% year on year is a very major driver of the growth slowdown. So I think the RBI should be, and this is where I'm being prescriptive. Let's see how the RBI acts. But my prescription would be to do much more of what they did, the 1 lakh crores that they did in one day, given that about 5 lakh crores has been withdrawn because of the currency market interventions. And they may need to do more there. They need to do a lot more in terms of durable liquidity improvement. They may also need to slow down a bit on some of the loan deposit ratio norms that they were trying to enforce. I think there is an opportunity also in reducing the risk weights, the macroprudential measures, where suppose the real estate cycle is in a decent place right now, you can reduce risk weights on say mortgages, and therefore trigger some more loan creation in that segment. If you can get bank loan growth up from about 11% to say 14, 15%, I think the economy will start to recover. So that's the area where a lot more work needs to be done. I wouldn't obsess too much about a 25 basis point rate cut, which anyway will show up with a lag in the economy many, many quarters later.